Claudio, how does this PMI read actually really move the dial for you at all? Because it was a massive, massive gain.
Good morning, Rishaad and Yvonne. I would say, just listening to your program, really the theme in a certain sense is we'll take whatever we can get. I mean, the market sentiment was so bleak that some improvement on COVID restrictions, some improvement on the PMI, some level of discussion between China and the United States on taking back some tariffs, that, given what we've been through, should be taken, particularly given the squeeze that we've had in the market, or the short positions that we've had in the market are being squeezed as a consequence. So I think the market will take what it can get for the moment. But as you quite rightly say, we will revisit the issue as to how meaningful or how sustainable this is probably in a couple of weeks as we get through this.
And on the tariff news as well, Claudio, I'm just wondering, we saw risk assets rally. You're seeing commodity currencies also get a bit of a lift here. I'm just wondering, how sustainable are these moves given the fact that the global macro backdrop is still very much central banks are tightening?
Yeah, I think, the narrative that we've seen over the week as well, past couple of weeks, is that we're caught between a rock and a hard place in the sense that we get the sustained tightening, but it's ever more apparent that we're getting a recession priced into the market. And that hasn't been good for risk asset flows or equity flows, in particular for the Asia region, where we've seen portfolio outflows impact. So I think maybe if we get a combination, let's say, of this top-level good, incrementally better news, coupled with a reasonable non-farm payrolls number, stronger than expected, as we expect 320K on non-farm payrolls on Friday, but maybe average hourly earnings being in line. Maybe in that sense we can get some sustained rally going through, that actually we've got some resilience in the U.S. economy that will still carry us forward, and we've got maybe some attempt at trying to deal with the inflation issue. I think that's the frustrating thing. I mean, what is motivating this discussion is, in a certain sense, is that, not only do we have high inflation, but politicians and policymakers around the world need to be seen to be doing something, even whether we can question whether effective it is, but we need to see people moving and acting to deal with the issue. Yeah.
Claudio, I mean, it's quite surprising, to say the least, that China doesn't seem to have an inflation problem like the rest of the world does. That's putting that to one side. But does all this data and this sort of bifurcated economic cycles really, what do they mean for the yuan? What's its path of least resistance?
Yeah, well, from that perspective, we still think the path of least resistance is for renminbi depreciation. I mean, we expect the renminbi to consolidate here, but as far as our year-end forecast, we've got dollar renminbi at 7, going on to 7.1 at the end of the first quarter. We still feel that the overall direction of travel is for further easing in China. Yes, we've had a bit of improvement on the credit impulse, but we still need some carry through. And from that perspective, as you quite rightly say, we'll get CPI numbers possibly on Saturday for China, and that will still show this kind of divergent pattern where China's inflation pressures are less apparent. The growth of pressure is still there, even though we've had this bounce in the PMI, and that will lead for dollar renminbi still to assert a higher dollar China trajectory for the end of the year.
We certainly have seen some pretty remarkable outflows in North Asia. You talk about Korea, Taiwan, even India looking pretty bad as well. I'm just wondering, should we expect more of that story in the second half, Claudio?
Yeah, I think, it's a certain, how should one say, it's 25-year anniversary of the Asian financial crisis. Things are certainly very much more different, but clearly we're seeing depreciation pressure. The other thing that we have, other than inflation data this week, is we have FX reserves data out this week from most of the Asian central banks. And again, what we're starting to see is that those FX reserves are being drawn down as Asian central banks start to smooth and try to defend their currencies, particularly about Asian appreciation aggravating the inflation pass-through through import prices and higher commodity prices and depreciation. So that is an acute issue. But I think we will see very much a smoothing of the depreciation pressure rather than any attempt to try and reverse or take the market head on.
And Claudio, it's just amazing kind of the change in expectations that we've seen from the RBA in just the last few weeks or so, whether it was, where they're going to wait for wages to pick up before they start hiking. And now we're talking about back-to-back 50 basis point hikes. Do you think a 50 basis point hike is going to really rescue the Aussie bulls now?
Well, I think a lot of it is already priced. But yes, we're in the camp of 50 basis points. I think the market will be closely following and reading that final paragraph of the policy statement to see how committed they are. Any softening of that tone would be negative for Aussie. But I think at a minimum, if we get the 50 and still an aggressive kind of hawkish statement coming through, that will help to keep Aussie supported. I mean, Aussie's had a rough time of late. And again, I think we've seen in our positioning data the market trying to turn and add long positions to the Aussie. So at a minimum, we need 50. And we need the hawkish statement to give the market the confidence to keep adding to those longs. Anything short of that, there'll be disappointment, and some of those burgeoning long positions will have to be cut.
Claudio, just interrupting you for a second, because I mean this is something which may well also be moving the dial, and it is Janet Yellen and Liu He. We've been talking about them on a video call. Accordingly, they have been discussing the economic outlook, looking at these rising commodity prices and looking forward to future talks. Of course, Yellen said that she raised concerns about the Ukraine war and China's economic practices. But it's actually quite interesting that they've been looking here at those rising commodity prices too, which is of course something which Australia benefits from. And what does it mean? What is the deal with FX amongst those commodity-orientated currencies now?
Yeah, there's a lot of cross-current. I mean, we've seen some sign maybe that the China property market is starting to revive, but when we look at some of the higher frequency data in terms of steel, iron ore, and so forth, it's still quite soft. So in terms of the demand pull from China, it's not overly convincing, although, again, the credit impulse data suggests that could be coming through the pipe. At the same time, clearly global commodity prices should be favoring the Aussie, but it hasn't really pulled the Aussie as had been expected. Really what's doing the heavy lifting in some sense is the domestic economy in Australia. The fact that the labor market's strong, that's pushing the RBA to keep tightening or hike more aggressively, which is lending some support. So we need, the stars to align. We need, RBA policy to keep hiking. We need China data to keep getting better, and we need some kind of better global cooperation and understanding and improvement in China-U.S. relations to help that move along. Let's say if we could get 2 out of 3, that would be great, but we're still working on 1 out of 3, and that's why Aussie dollar continues to limp along.
Claudio, people are looking for some kind of direction when it comes to the second half. In terms of convictions, trades, do I focus on G10? Do I look at relative trades in Asia? I mean, what is the kind of the trade for the rest of the year?
Yeah, so I mean, our main plank still remains short renminbi. At the same time, we also think dollar Korea can go to 11.35. Again, this negative factor in terms of commodity prices. We like to align it with maybe being a long Sing, because we think the FX policy there is still skewed to 100 basis points increase in the slope in October, plus a full recentering. That could be another 200 basis point one-off appreciation of the Sing on a trade-weighted basis. Your point about relativity is very well taken. All of our clients, including ourselves, are really focused on FX reaction and also central bank reaction policy functions, how they are reacting to inflation, whether they hike more, use more fiscal policy, and so forth. So that's another key trait. Sorry.
Claudio, we do live in strange times. Looking at the euro, it's not being helped, of course, by Germany's first trade deficit, and quite a whopping one since 1991. We've got a Swiss franc, which is really behaving like the old Deutschmark. Then we've got sterling, on the other hand, which some say is acting more like an emerging market currency.
Yes, I mean, it's no longer black and white between, developed, emerging, and so forth. Each and every country and currency is being judged on its own merits, and I think that what you've just said, Rishaad, is very, very poignant. So from that perspective, yes, we will be bearish on sterling. We believe, in some sense, euro-dollar year-end forecast is 105. That's really base marked on peak tightening in the Fed priced in, and also policy in the ECB priced in. But I do think the trade shocks are coming home to roost. So I do think we're getting a deterioration in current account balances, in trade balances. The shoe is going to drop in China, and the shoe is dropping in Germany because of these sustained commodity prices. And so we've had the inflationary impact, but I think what we're going to start seeing is much more of the trade impact come through as well.